Time right now for our Squawk Picks. Our next guest has three top picks: Meta, Uber, and Amazon. Joining us right now to explain why we should buy these stocks is Mark Mahaney. He is Evercore ISI's head of internet research. And great to see you, Mark.
Good to see you too, Becky.
All right, let's talk a little bit about what your favorite stocks are right now and why.
Meta's first. It's the cheapest high-quality tech stock out there, period. 14 times GAAP earnings, and it's got three product cycles that it's going through. First is this Reels monetization. They successfully borrowed from or stole from TikTok. Second is they've got this click-to-message product that's out in the market that's doing well. It's $10 billion revenue run rate. And third is I think they've just been able to recapture a lot of the advertising signal that they lost when Apple went through its privacy changes. So you're going to have a nice recovery in the revenue growth as you go through the year. It's already started to accelerate, actually faster than any of the other ad platforms because of these product cycles.
Was changing their name to Meta the wrong move?
Yes, I actually think it was, and I think it's one of those things that they're going to regret. I think they already do regret it, but yes, it was. I think, and also investors kind of told them that too, because a lot of the market cap was taken out. You had a lot of people sold the stock last year for good reasons, but one was this excess focus on the metaverse. They should be investing in the metaverse, but maybe more to the tune of $5 billion rather than $15 billion. Investors would love to see them cut back on that. If they announced that at the shareholder meeting today, it would be a positive.
If they announced that and changed their name back?
Yes, but I don't think that's going to happen.
I don't think so either. That would be too much of an admission.
Yes.
No new Coke for them.
Yes,
okay,
that's right.
What's number two?
Two, Uber. You got three value catalysts here. So we like it, $75 price target. First catalyst is they're going to reach finally GAAP earnings status. They're going to start actually generating positive GAAP earnings. Second is we think they'll start buying back stock. And third is that we think they'll finally reach the metrics needed to be included in the S&P 500. And so I think sometime in 2024, you're going to have a new addition. It's going to be Uber. Normally, that's a good catalyst for stocks.
And what's number three?
Amazon, triple trough thesis. We think the stock right here is at a trough multiple, trough margins, and trough revenue growth. If we're right on that, you could have a material re-rating in a stock that's really underperformed for almost 3 years.
Let me ask you about some things from your book. I haven't read through it, obviously. You just handed it to me. Nothing but net. But I'm looking through, and you are positive on tech stocks most of the time when we talk to you. It's paid off in a lot of ways. If you were an early adopter of Amazon, if you saw some of these things, you look at these stocks differently, though. There's a reason you have to look and value internet stocks differently. I think it has to come from some optimism. But you also talk about what some of your biggest mistakes were. How do you maintain optimism but still not get trapped in stories that are never going to pay off?
Well, I've certainly made plenty of mistakes along the way. I've had buys on things like Blue Apron that blew up. I was a bull on eBay for too many years. You know, probably in 2007, I became cautious on it. I should have become cautious a couple of years prior to that. So I made plenty of mistakes along the way. I've watched this industry mature, the internet mature. And so these companies increasingly, when they act their age, when they start focusing more on costs, when they start giving back stock, cash to shareholders, wealth to shareholders. I like to see those kind of things. So the older the company, the more mature I want them to act. That's one of the reasons you went through this massive shift in Facebook last year. They began last year acting as if it's growth, growth, growth. Investors sold the stock because of that. When they shifted gears and said, we're essentially middle-aged, we need to act that way, we need to focus on cost, give back more cash to shareholders, that's when the stock started to turn around. So I've sort of lived and grown up through this evolution of these companies. They've gone from young, go-go growth companies, and they were priced like it. But when the reality changed and they no longer were in that status, they needed to change the way they acted, and they did. Some of them did. Google and Facebook, I think, did.
Does that mean you would not invest in toddler or teenage companies at this point?
No, but you have to realize what the company is. So that's a very hard thing to figure out. Like it's all right to run without profits if you're early stage and you've got real super premium growth. If you don't have premium growth, if you're not growing your revenue well north of 10%, 20%, you better be showing that profitability. Yeah. There's this old rule of 40 in software. You know, the lower the revenue growth, the higher the margins. That's completely relevant to most technology companies, I think. So when your growth slows, you better show something, you better give something back to investors.
There are times where the market completely disavows that, where they pay no attention to that. They're looking for growth at all costs. We've been through recently another round of that, maybe because there was so much liquidity.
We went through super easy money for a couple of years, maybe 3 years there, and 2019, 20, and 21. And then the markets changed, and the companies needed to change their strategies accordingly. And I think the stocks that have held up the best did. That's why Amazon's a bit of an outlier here, because they're still investing aggressively. They're not returning cash to shareholders. I'm not sure they need to, but they better show some material revenue growth acceleration. And if they don't, then they need to start becoming more mature. Then they need to start returning much more cash to shareholders.